Everybody, and welcome to Saxo's Global Markets Call. It is Monday the 5th of March, and in Italy the voters have punished the establishment parties for years of economic decline, rising taxes and immigration. The initial results suggest we have a hung parliament and no one group is commanding a majority, so it may take some time to find a new government there. Better news out of Germany, where the political stalemate finally has ended after the SPD membership voted in favor of the Grand Coalition with Merkel. 66% voted in favor, and this actually clears the way for a fourth term for Merkel as Chancellor. We will start today with a comment on equities by Peter Garnry this morning.
Thank you, Chris. So I think the theme for equities this week is that we will tread waters here. As I mentioned last week, I think we have established some a trading range here. You also seeing that sentiment is still being impacted by the impending trade war with the US imposing 25% tariffs on steel and 10% on aluminium. We have Mexico and Canada really on their toes here and want to retaliate big time. Meanwhile, China seems to be still quite muted on the whole case, but nevertheless, investors in Asia are worried and they're sending down Asian equity markets down by around 1%. You can see on the chart, this is the Hang Seng. We're just flirting with the 100-day moving average. It seems like we could have a support level down from the lows here in late November, early December. That would be around the 200-day moving average. I would suspect that we'll stay in this trading range. It fit with what we're seeing in the S&P 500 and in Europe. European equity markets this morning are a little bit more calm, but let's see what happens when the cash markets are opening. We're seeing very little widening of the spreads in the bond market, but also equity markets. I think the DAX is around 0.4% down, so nothing major. And as Chris said, Merkel's in for her fourth term as German Chancellor, as a Grand Coalition, so that will create some more stability and create a more firm axis around France and Germany going forward here. Italy is the big joker. 5-star clearly was the victor with more than 30% of the votes. The election outcome is a hung parliament, as Chris said, so let's see what happens. But in terms of the equity markets, the worst case scenario would be if the 5-star came out with sort of being leading a government here in Italy that could really stall the European banking union process, which is very key for financial markets in Europe and the ECB, and that could really create some hangovers in the financial sector. So that's obviously something that we should be watching here. And then basically with the sentiment being weak, where should you hide? There's no clear pattern yet. If we take the 26th of February as the starting point for the second wave here of selling, obviously the cyclicals are down the most, but it's not much. The defensives are doing okay, but it's the two clear segments of the equity market where you have had protection is actually in Asian equity markets, and then overall in US technology and technology stocks more broadly. And technology, if you go on trading floor and look at my piece from last year on where we analyze which sectors are performing through different recessions, you can actually see that technology over time has become a more and more defensive sector, which is quite interesting. And then on the single stock land, we have the big French insurers. AXA is bidding for XL Group. XL Group, as you might remember, was one of the reinsurance companies that were hit the most during the Hurricane Harvey last year, plunged, and then has ever since been an acquisition target. And AXA is now offering a 33% premium above Friday's close price. So watch the stories that unfolds. It will really create a very big stronghold for AXA in the US property and casualty market. And with that, I'll give the word to Ole on commodities. Thank you.
Thank you very much, Peter. We have quite an interesting week ahead in commodity space. A lot of different things and themes unfolding. We obviously have the ongoing tariff war, and what we're waiting for now is probably the retaliation or the response from some of the countries being impacted by Trump's tariffs. CERAWeek, which is starting in Houston this week, brings together oil executives from around the world, including also members from OPEC. So that's going to be interesting to see. And then we got on Thursday we got the agricultural supply demand estimate for grains, which is obviously very important following the big surge we had over the past month. And China's focus as well, both from the perspective of their response to the tariffs, but also the big meeting they have by the elite over the coming 2 weeks, where they're going to set annual targets. But oil, first of all, it's trading a tad higher this morning. Libya has seen a supply cut of close to 1/3 of its daily production. A temporary closure of a pipeline has caused this disruption, but we're also seeing that it's being offset by the continued stock market weakness and the stronger dollar on the tariff worries. There's been some focus recently on this very elevated speculative interest we have in crude oil. The FT had an article last week basically where highlighting that some of these funds holding a record long, they care little about oil fundamentals and they're more driven by overall macro outlook. And we can most certainly see there's been quite a decent correlation between stocks and crude oil in recent weeks. And if this is to continue, then obviously the S&P direction will have a place part to set the direction on oil. Funds they added crude oil back last week. They were net buyers for the first time in 5 weeks. I think the weakness that we saw last week is not something that's worrying investors at this stage. We need to hold above 61 on Brent and 57.50 on WTI. These are really the two key levels. A break there could set in motion a potential another 5% to the downside. Industrial metals, as I mentioned, they will very much be focusing on China. Copper remains range bound between 3 and 330. Funds have now cut bullish bets by almost 2/3, so they have increasingly been losing faith in higher prices at this stage. Gold has bounced strongly after hitting support at 1,300 last week. The uncertainty that is deriving from Washington is helping to support the market, but we do have a key area of resistance just above here between 27 and 31. Got trend line from the recent highs, 20-day moving average, and 50% retracement of the February sell-off. So this is really the area that need to be challenged in order for this advance to continue. And then finally, as I mentioned, grains could potentially just pause ahead of Thursday's WASDE report. The sector has been in very strong demand over the past month. First of all, due to short covering, we had a record short back in mid-January. That has now been closed, and now we have some elevated longs, especially in the soybean sector, due to drought condition in Argentina. But it is the weather that is starting to wake up the market. We have the battle now between record high stock levels left over from previous years and the increasing uncertainty about the production outlook over this coming season. But as I mentioned, WASDE report on Thursday will be the highlight of the week there. That's it for me, and just finally to give you an idea about the cut report. We saw bullish bets jump last week, primarily due to the renewed buying in grains and also renewed interest for the energy sector. I'll send out the cut report on tradingfloor.com within the hour. Thank you very much.
Good morning from the fixed income team. So starting off from the US, as Ulla and actually Peter commented before, last week the biggest news was actually the decision of Trump to impose tariffs on steel and aluminium. This is actually a very controversial decision, as it will put at risk the North American free trade. Obviously, at the end of the week, last week, we have seen investors that were actually selling off as they fear a trade war and actually a more robust inflation than what we expected. As a consequence, US 10 years Treasury yields rose from 2.79 to 2.86%, and we believe that actually there is more space for a bigger downside, especially now that governments worldwide could start to retaliate, especially China, by reducing purchases of US debt, which could actually push Treasury yields even higher. In the corporate space, we believe that the biggest losers will be steel consuming industries, like for example automaker, plane manufacturers and so forth, and obviously metal producers in Canada and in Europe. Passing on instead in Europe and looking at the Italian elections, Italy is still counting the votes. However, it seems that the results will be a hung parliament with the five-star movement to be the largest party, but the center-right to get the higher number of seats in the parliaments. We believe that actually this will have a little impact on the market. There might be some weakness in the periphery, especially in Italy and in Spain, but by the end of the week, these should be stabilized. And the reason behind this, it's actually that it's not that uncommon for Italy to come up with a hung parliament. Just to give you an idea, since the Second World War until 1993, Italy had 52 governments, and each one lasted around 10 months. Since 1993 until today, Italy had 13 administrations, giving basically an average of 20 months per administration. So this is not actually something that is new. It's something that happened before, and we believe that it will have a limited impact in the market. On the bright side, however, in Germany, the SPD voted in favor of forming a new coalition with Merkel's bloc. This basically means that Merkel will probably be re-inaugurated as a chancellor by mid-March, and this actually strengthens the position of Europe and should be favorable for core Europeans' yields. So this is all for us, and now I will pass it to Chris to finish up.
Thank you, Althea. Yes, that's all for us today. We will return again tomorrow at 8:40 CET as usual. Have a nice day.